A very warm good evening to all. Welcome to the ninth session of day 8 of the NTA net coaching classes conducted by the Department of Commerce, Commerce Club of the Department of Commerce, University of Kerala. Today we have Dr. Biju, AV. He is the Assistant Professor of Commerce at the Department of Commerce, University of Kerala. And today he is as a resource person to take his session on the topic business finance. Spanning over a decade, he has varied teaching experience under the Collegiate Education Department. He is also a trainer of ASAP Government of Kerala and for National Stock Exchange courses such as NCCMP, NCCFM Pro. He is an active researcher in the areas of finance, especially behavioral finance and stock market. He has published various textbooks, which is being administered by the affiliated colleges under the University of Kerala, and has authored various papers and articles in journals having high impact factor and has acquired good citations. His research areas interest and include corporate credit, personal finance, market microstructure, bibliometric analysis, text analytics, and social finance. He is acting as the editor of IGI Global Journal, which is listed in the Web of Science and Scopus. Welcome to the session, sir, and very warm welcome to all the participants here for the session.
Thank you, Snehid, and thank you, Lakshmi, to have an opportunity to address the UGC NET aspiring students of Kerala, right? Any other language? All Malayalis, all Kerala people, or any other person from outside? Okay, leave it. I can start my presentation. I have chosen the topic business finance, and this is my overview of my presentation. I will cover the areas because it is not easy to cover because each and every topic we need a couple of hours to finish it. So I will give some kind of insights about the topic. I would like to suggest so you have to have a deep in-depth understanding of this topic. That means each topic is been a keyword, and you can search papers or other documents available from the internet, and you can learn in-depth conceptualization of this topic. So I will cover source of finance, capital structure, dividend policy, working capital management, international monetary system, GDR, ADR, foreign exchange management, and asset securitization. I think these contents, majority part of the contents in the business finance topic as specified by the UGC. Am I myself audible right now?
Yes, sir, it's perfect.
Okay. So first one, source of finance. Source of finance shows the financial structure of firms. So you might have experienced the financial structure of the firms. Financial structure combined, many type of finances, many type of many components which consist of many type of finances. Different types of structure used by the firms. So we can see different structure followed by different firms. So out of that, first one is short-term finance. Short-term finance is, like below 1 year. It has to repay within a period of 1 year. So it consists of bank overdraft, bill discounting, advances from customers, installment purchases, bill of lading, financial institutions, trade credit. So some of the firm using this kind of thing, some of the firms may not. It depends on the decision of financial manager's decision to take avail this source of funds, right? So then medium-term finance, it's 1 to 5 years. It is used for balancing modernization and replacement of machinery and plant. Maybe hire purchase, loan from financial institutions, debentures, bonds, other insurance companies. So these kind of finances are treated as medium-term finance. In long-term finance, it's a permanent basis finance and its duration more than 5 years. They are basically designed to meet structural changes in business or for heavy modernization expenses. So these are also needed to initiate new business plan or for a long-term development projects. So equity shares, retained earnings, leasing, again loans from financial institutions means long-term loans comes under the part of this long-term finance, and debentures. So these are the part of long-term finance. So this is a source of finance. So source of finance, I think these topics are very easy topics. You can learn through books or other sources. So you have to have a conceptual understanding of all these sources. Okay, so questions may be asked from each and every sources like equity shares, leasing. It is covered. All the sources are covered in the syllabus. So you have to have a clear understanding of each and every sources. Okay. Then next, cost of capital. Cost of capital is the minimum rate of return a firm must earn on its investments. So cost of capital is a minimum rate of return a firm must earn on its investments. So if the firm earn the minimum rate of return, so that the market value of equity shares of company does not fall, right? So if the firm did not earn a rate of return, that will be affected to the market value of equity shares. Okay. So source of finance is a minimum return expected by its suppliers. So the source of finance is minimum return expected by suppliers. So expected return depends on the degree of risk assumed by investors. So we have, we are taking some sources of funds to finance the business, and we have to earn a rate of return which would be higher than the cost of finances, right? So the expected return means, so suppose you are taking a bank loan, and the bank charges an interest. Interest depends on your financial soundness. If you are financially incapable or your financial soundness is not good, financial capacity is not good, the interest may be higher, because a firm who are giving the finance is taking huge amount of risk, because they are giving money to a firm which is not, their structure is not good. Okay, so everything is related. So the rate of return is termed as the cost of capital, but each and every sources has its own cost of capital. When you take a bank loan, the interest is a cost of capital. When you issue a bond, the interest of the bond is termed as a cost of capital, and the firm is getting some rate of return is also cost of capital. Okay, so so debt is a cheaper source of funds than equity. It is a principal statement. So why debt is cheaper than equity? So using the component of cost of capital as a criterion for financing decisions, a firm would always like to employ debt since it is a cheaper source of finance. But the firm should be careful while using the debt. What happens if the firm using over usage of debt? Then the firm is not able to service the debt, not able to pay the principal amount and interest of the loan or a debt, as the case may be. the firm will be in a position like financial distress. Okay. So, but in financial theory, we can say that debt is cheaper than equity, because so whatever amount paid as interest on debt, it can be deductible from income tax while calculating income tax. So that debt is more cheap, debt is cheaper, and we can use the debt. But I don't think so, because all the firms are interested to use the debt. Okay, but the shareholders are not interested to invest in a firm which is using huge amount of debts. So the moderate level debt would be fine. So opportunity cost of capital, it refers to the cost of next best source of funds. Okay, so there are many sources of funds. We have to adopt which one is best. The source of capital consist of equity shares, preference shares, bonds, debenture, loan, crowdfunding. So we can use any of these. Suppose we are using, IPO, initial public offer. So some other next best is opportunity cost of capital. Okay. Is there any interaction? Do the audience will interact in between, or they will ask questions after my presentation?
So we can provide that after the presentation, sir.
Okay. Cost of equity. Some arguments that equity capital is cost free. Why it is cost free? As a company is not legally bound to pay the dividends to the equity shareholders, because once you purchase a stock, the company will not repay it. Suppose you purchase a share of Zomato. So once you purchased, and if you want to repay back, you have to sell the particular stock in the open market. Otherwise, you cannot get back the amount invested in Zomato shares. So the company is safe in the sense, once the shareholder purchase, the ownership is divided to that person, but the company no need to require to repay back the amount invested by the Zomato shareholder. So that the equity capital is cost free. So, but this is not true. Shareholders will invest their funds with the expectation of dividend. So what happened? If the shareholder did not get a return as he expected after purchasing of Zomato or some other company stock, what he do? He will sell the shares. So what happens if all the shareholders sell the shares? Then the company's market price come down. The company will be in a pathetic situation. So you can have experience so many companies situation. You can take the example of Ace Bank. What was Ace Bank before 5 years? It was traded in 750, 800 rupees. Now it is been traded in 10 rupees. Because the bank was not getting profits. Last couple of years, the bank was suffering from huge amount of losses. So the people started selling shares, and the bank, bank was the position right now, selling of shares in 10.5 or 11 rupees. Because the S Bank shareholders did not get a return as they expected. So they tried to sell out their stocks. So the bank was in trouble. Okay. So the market value of equity shares depends on the dividends expected by shareholders. So the market value, the cost of equity is a combination of dividend plus the market value plus the expectation of growth. You can find many formulas to find out the cost of equity. So many formulas. So out of the formulas, the best formula, I think I would say that it should count the market value plus the dividend expectation plus the future growth prospects of the firm. So all these being part of the it to be included in the formula for finding out the cost of equity. So when you refer books, you can find many formulas for finding out the cost of equity. You can find formulas for cost of debt and cost of retained earnings, etc. But the cost of equity, you definitely include the provision for dividend expectation, future growth, and the market value. So all these things should have a provision for the calculation of cost of equity. So that's the recurring rate of return, which equates, that means the cost of equity, which equates the present value of the expected dividends. The present value of the expected dividends with the market value of equity shares is the cost of equity capital. So the expectation of dividends. It is not compulsory to pay dividend. I will discuss the dividend matter in later part of my presentation. Okay, so the recurring rate of return, which equates the present value of the expected dividends with the market value of equity shares. So the expected market value plus the expected dividend plus the expected growth. So everything, the combination of all these shall be included while calculating the cost of equity. Okay, so that the cost of equity is not cost. It is not cost free. It is very costly, because if the company do not satisfy the expectation of equity shareholders, the company is in trouble. So that the cost of equity is more dangerous. It is not cost free. Company should take care of the interest of equity shareholders. So that it is been said that equity capital is risk, dangerous, and it is very costly as compared to debt. Debt, it is cheaper at the sense the debenture interest or the debt interest we are paying shall be deductible while calculating income tax, as well as the debt, the bank giving debt to us, and they don't get the ownership. We can be able to repay back the debt as well as interest. Then there is no obligations at all. But equity is not like that. The next is capital structure. So capital structure is made up of equity and debt mix, right? So it is a proportionate amount of the total capital which combines equity and debt. So deciding the forms of financing, which source to be tapped. So in the capital structure, decision is very important. The financial manager has to decide the capital structure, and he should be careful while setting the capital structure. So he should decide which source to be tapped, their actual requirements, amount to be funded, and relative proportions. What is a mix of total capitalization? So this decision is very, very crucial for maintaining the value of the firm. The capital structure has a strong connection with the value of the firm. Okay. So value of the firm means the value of equity shares. So capital structure decision will decide weight of debt and equity. So the financial manager has to decide the weight of debt and equity, and ultimately the overall cost of capital as well as value of the firm. So there is a debate, discussion, and a lot of academic literature which contributes. Capital structure is relevant in maximizing the value of the firm and minimizing the overall cost of capital. So there are relevant and irrelevant approaches. There are people who said the capital structure is not relevant in maximizing the value of the firm and minimizing the overall cost of capital. But some others, they believe that they have written like that capital structure is relevant in maximizing the value of the firm and minimizing the overall cost of capital. Right? So whenever funds are to be raised to finance investments, capital structure decision is involved. So a demand for raising funds generate a new capital structure. A new capital structure is formed whenever a new raising of funds, either the form of IPO or a company in which they are doing FPO. So the decision has to be made in the quantity and the forms of financing. So the debate is here whether the capital structure is relevant for maximizing the value of the firm, or the wealth of every company's decision to every company's aim is to increase the wealth of uh, the stakeholders, wealth of the shareholders. So that's the value of the firm, and reduce the overall cost of capital. The cost of capital can be reduced. So there are theories. So I will discuss the theories. So the theories, I would say the theories. Some of the theories are says that capital structure is not relevant. Some of the theories says that capital structure is relevant. So relationship between cost of capital and capital structure. So cost of capital has a direct relationship with the capital structure. When we predict the when we decide the capital structure, we are taking care minimizing of the cost of capital when we decide the capital structure. So the capital structure in turn depends on the stage of the company. So this is very important. The stage in which the company. So uh, when a company, they are incorporated, there are stages of starting of a company, promotion, incorporation, and certificate of commencement of business, and after that they can start the business. But it is very difficult when a company, soon after the incorporation, they can go for the market for raising of capital through IPO. It's very difficult. So our initial company, they will try for some bank loan or crowdfunding, etc. So initial stages of the company, it relates heavily on the debt component and try to break even as early as possible. So with the use of this debt, and they can find it, or they try for the break even point. That means a no profit or no loss point. And after that, they can think about IPO. Recently, you have witnessed IPO of Zomato, and Zomato is an old company. It's not an old company; it was a startup company, and they are the market leaders of food distribution in India, and they were in a loss position, and they used debt, full of debt for in the promotion stage, and 3 months back, they have tried for IPO, and IPO was very successful, and they have fixed the price of 75 rupees. Now the Zomato is trading in 141 level in the market. But you may ask a company using more amount of debt how the IPO was successful. But this is true that an initial stage of the company, it is not practical when a company go for an IPO. It is not possible. So the company always, initial stages, company looking for debt as well as
If I may
crowdfunding,
interrupt.
etc., for financing, for design capital structure. So after,
So there is a audio break sometimes. If it, I think it would be better if you could mute the video. Then it would be much clear in audio.
okay, fine. Okay, am I audible right now?
Yes, sir. It's perfect now.
Okay,
It's clear.
okay, okay. So the equity, what I'm saying, relationship between cost of capital and capital structure. So what I'm saying is, initially a company go for debt rather than equity, and after that, a couple of years has gone, and company is in a stage or a brand, because Zomato, Zomato started as a startup undertaking, and they have taken debt as well as crowdfunding and startup seed capital from means many people, and after that they have keep their brand as popular, and they are number one brand in food distribution in India. And that stage, Zomato was able to catch funds through IPO. Okay. So nowadays, people believe that Zomato will be they are expecting, the shareholders are expecting more, so that these people purchase shares, because they are believing Zomato. They are believing in the future of Zomato. Okay. So the equity component is heavily lesser costlier than debt, and is also the company try to expand its business. So at this juncture, the debt component is low. So there are stages. First stage, company using debt, and second stage, company used IPO. So whenever the company used IPO, the company was trying to reduce the debt. So now the Zomato did that way. They have, they have, I think 70,000 crores or something, 90,000 crores. They have got from the initial public offer, and with this money, their main purpose, they have stated in the IPO, this fund they used for some development purpose, as well as they are intended to reduce the debt content in the capital structure. Okay. So the company tried to show that to the public that it has low debt capital burden. Okay. So the company, now the Zomato, they are using, like, they wanted to reduce. The company is in lows. I will show you the financial position. So if you search Zomato, so take financials. So Zomato is in lows position, that is trailing recently 12 months, last 12 months. Zomato's EPS is negative, and their operating loss and their net income is negative. Okay, so this company and the same status 2019-20, their net income is negative, but you can find that their loss is reducing over a period of time. 2020-21, the losses has been reduced. So the future expectation of Zomato is more. Okay. But you can take some other company. You take ITC. This is a profitable company. You can find that EPS is positive and their net income is positive. Okay. But you can find a growth of it's all expectation of Zomato rather than ITC. So ITC is not traded, but Zomato price is moving up over a period of time. Okay. But ITC's profit is increasing, but the future expectation is less. Expectation is very important while calculating cost of equity. So optimum capital structure, another terminology is very important. Optimum capital structure is capital structure in which the weighted average cost of capital is minimum, and thereby the value of the firm is maximum. So I already pointed out the capital structure in which the total cost of capital should be minimum, so that the company can maximize the value as well as wealth of shareholders. So that point is known as the optimum capital structure, the level of capital structure. So the financial manager is interested to maintain an optimum capital structure so that the cost of capital is minimum and value of the firm is maximum. So the principles of capital structure, there are principles of capital structure, cost principle, risk principle. A finance manager should consider all these principles while setting the capital structure. Cost, he should consider the cost of capital, he should consider the risk of finance, he should consider the control aspect, he should consider the flexibility. Means if the financial manager raise entire funds from equity capital, there is no flexibility. Okay, so timing, etc. So timing of IPO, timing of FPO, these are very important. Otherwise, the IPO will be a failure. So timing of raising finance. Sometimes IPO, the IPO is means IPO environment is not favorable. So the people are not interested to subscribe shares issued through IPO. So that situations you can find, the finance manager can see that from other sources. He may raise through bonds, he may raise finance from bank, loans, etc. So these principles are important. Okay. So theories of capital structure. Theories are net income approach. So these theories, these theories saying about the relevant and irrelevant means the connection of the linkage of the capital structure with the cost of capital as well as the value of the firm. I already explained that some of the theories say that capital structure is relevant for maximizing the value of the firm, and some of the theories stated that the capital structure is irrelevant, means capital structure do not have a connection with the value of the firm and overall cost of capital. So net income approach says that means this capital structure is relevant in the sense that a change in the financial leverage would lead to change in the cost of capital. So in short, if the ratio of debt in the capital structure increases, the weighted average cost of capital decreases, and hence the value of the firm increases. So this is a part of relevant theory, and net income approach believes that if the ratio of debt in the capital structure increases, the weighted average cost of capital decreases, and hence the value of the firm increases. So using of debt or leverage is important to reduce the overall cost of capital. And if the overall cost of capital is reduced, the value of the firm is also increased. Same thing. Then net operating income approach. It is an opposite of net income approach if there is no taxes. If there is no taxes, it is opposite of net income approach. So net income approach says that leverage is important. If the firm using leverage, the overall cost of capital is reduced. But net operating income is opposite of net income approach. So this approach says that weighted average cost of capital remain constant. So it believes in the fact that the market analyzes a firm as a whole and discounts at a particular rate which has no relation to debt equity ratio. So the market analyzes the firm as a whole and discounts because the thing is shareholders are very conscious about the capital structure and they are not interested, the firm is in position of high leverage and they are not interested to invest. So if the people are not interested to invest, that means the cost of equity increases. So the increase in the cost of equity will be exactly compensated with the increase in the benefit through usage of debt. Because the firm is overusing of leverage, the shareholders are not interested. So the improper maintenance of debt equity ratio will be a costly one. So that net operating income approach is against net income approach. Net operating income approach says that the capital structure is irrelevant if there is no taxes. But if there is tax information, if there is taxes, so the weighted average cost of capital can be reduced and the value of the firm can be maximized with the capital structure. So the capital structure is relevant if there is a tax information. If the capital structure is irrelevant if there is no taxes. So that's a net operating income approach, right? So traditional approach, this approach does not define hard and fast facts. It says that cost of capital is a function of capital structure, is closely related. So the special thing about this approach is that it believes an optimal capital structure. So traditional approach believes an optimal capital structure and capital structure is relevant for reduction of the cost of capital. And the other one is approach, Modigliani and Miller approach. So it is a capital structure theory named after Franco Modigliani and Martin Miller. They have proposed two propositions, same like net operating income approach. The first proposition, the capital structure is irrelevant to the value of the firm. So the value of the two identical firms would remain the same. Value would not affect. They have, given some hypothetical situations like arbitrage process and all. So you can read, you can further study and read from the books the arbitrage process. The explained through the arbitrage process. And the two firms' value would not affect. So they have proved that two identical firms in different capital structure and their value would not affect by the choice of finance adopted to finance asset. And they proved with the help of the arbitrage process of two firms. So the value of the firm is dependent on the expected future earnings. It is when there is no taxes. So this similarly net operating income approach, approach also says that when there are no taxes, the capital structure is irrelevant because of the shareholders are interested on the expected future earnings. But the condition, if there are no taxes. But proposition 2, the changed his view and stated that the financial capital structure is relevant for maximizing the value of the firm and important for reducing the weighted average cost of capital if the tax information is available. Okay, so proposition 1 says that capital structure is irrelevant for reducing the cost and increasing the value of the firm, and the proposition 2 says that the capital structure is relevant because the interest on tax is an allowable expenditure by calculating income tax. This benefit we can take, and so that the overall cost of capital would be minimum and the firm's value can be increased with the usage of debt. Okay, so this is a proposition number 2. Capital gearing or financial leverage. This is also important. Capital gearing means the existence of fixed charge bearing capital, which may include preference shares along with the debentures and term loans. So the capacity or usage of debt, it can be effectively used to maximize the wealth of shareholders. But remember, the most important thing is the capital gearing is achieved only if ROI is greater than interest rate. Return on investment is more than the interest rate or interest rate paid to bonds as well as debentures and loans. So the interest rate, return on investment should be greater than the interest rate. Then only the capital gearing is benefited. So capital budgeting, investment appraisal. This is also being part of the syllabus. So capital budgeting is about deciding where to invest the capital. So till the last slide, we have experienced about the source of finance and deciding of capital structure. Okay, so first we decide the source from where we can fund either equity shares or debentures or bonds or startup financing, seed financing, crowdfunding, etc. And after that, we decide the capital structure. Okay, so the next is investment. So here the capital budgeting techniques are important. So what is capital budgeting? The capital budgeting techniques will help us to decide where to invest the capital or other resources. Okay. So it is a process that a company management uses to identify what capital project will create the biggest return compared with the funds invested in the project. So these techniques are important, to identify the capital project will create biggest return. So here fully forecasting. So we are predicting the future situations, but it is very risky. If the amount invested we cannot revert back, so that we should be careful while using these techniques. So each project is ranked by the potential future. So many projects we can have, but the capital is limited. So we have to ration. It's called capital rationing. Means allocation of the funds to more prioritized projects. Okay. So each project is ranked by its potential future return. So the company management can choose which one to invest in first. So we have to decide the priority, which one is to be financed first. Okay. So the project may be purchasing of new equipment, rebuilding existing equipment, purchasing delivery workers. So last 2 days you might have experienced the news that the Ford company stopped operations in India. So Ford is an American company, and this year the American based company, and there is no news about this year's a capital allocation to Indian continent, means factory, Ford factory. So that time also some news about the closing of Fords, and last 2 days it was confirmed that Ford company were closed operations in India. So maybe it's due to lack of capital budgeting or investment appraisal techniques. Okay. So the purchase of new equipments, rebuilding existing equipment, purchasing delivery vehicles, constructing additions to buildings, etc. The large amount of spend on these type of projects are known as capital expenditures. These expenditures are known as capital expenditures. So the methods, so many methods: accounting rate of return, average accounting return, payback, net present value, profitability index, internal rate of return, modified internal rate of return, equivalent annual cost. Some of the people, there are debates which method is better. Many people say that net present value is better. I have seen some questions also, which method is better. So there would be answers like net present value, IRR, payback, and I have seen some solutions also. Net present value is best method. So I cannot find the reasons behind net present value method is best. So many financial managers, they are using various methods, and it's based on their convenience. So whatever be the inputs of data. So based on data, we can use these methods. So we can use appropriate methods for us. So which company using, because it's industry wise, it is different. Company wise, these methods are different. So methods: payback period. Payback period measures the time in which the initial cash flow is returned by the project. Cash flows are not discounted here. Here, low payback period is preferred. So it is not suitable. I would say it is not suitable for a startup undertakings. So startup means they are started only, and they are gaining after some years. But if we use the payback period for startups, this payback period is not appropriate for startup undertakings. Okay, then discounted payback period, it considers the discounted value, because cash inflows are to be discounted, because money received today is more important than money received tomorrow. That is the basic principles of time value of money. So this time value of money principle are to be considered. So the discounted payback period consider the time value principle. And the next one, net present value. Net present value consider the time value principle, and they are using the cash inflow, and higher net present value is preferred. So the net present value is calculated it is equal to the initial cash outflow less the sum of the discounted cash inflows. That means discounted cash inflows minus cash outflow is equal to net present value. Then accounting rate of return, this considers the profitability of the project. It does not consider the cash inflow of the project. And here also discounted value is not considered because this considers only the earnings. It is been calculated net income, total net income of the project divided by the initial or average investment. Here, except all method, this average rate of return considers the earnings rather than cash inflows. Then internal rate of return. Internal rate of return is the discount rate at which net present value of the project becomes zero. Okay, so we should prefer the higher IRR should be preferred. So it's like a trial and error method. So you can see all these details from textbook. So profitability index is a ratio of present value of future cash flows of the project to initial investment. Okay, so these are the methods, most popular methods. But there are risks in capital budgeting. There are studies by considering the risk of capital budgeting. Exchange rate fluctuations. Okay, so another risk, because I quoted already Ford company business, means Indian business. They were struggling with the Indian business because of these exchange rate fluctuations, political risk, and economic stability. It is very difficult to make a car with low cost because Indian customers prefer low cost car and they want big car, but the cost should be low. So that it is very difficult to make car for Indian customers because they are selling car in America, Latin America, Europe, etc. Because these people are not conscious about the cost, but these Indian customers are conscious about the cost as well as they want more services. So it is very difficult to fight with other competing brands in India. Still, Indian car market is dominated by the Korean, Japanese car companies. So exchange rate fluctuations may be one factor of risk, political risk, economic instability, specifically related to inflation. So inflation is also another risk. So another one is cash flows are not deterministic. We cannot estimate the cash flows as perfect. So in addition to that, budget constraints of the capital budgeting, but budget constraints are also important. So in multinational capital budgeting, so I think that is in the syllabus. The multinational capital budgeting. Multinational capital budgeting feels this kind of domestic operations. Okay, so international capital budgeting is more complicated because of these kind of risks: exchange rate fluctuation, political risk, economic instability. Okay, inflation, etc. So it is particularly true where a host country bears political and financial risk. So another financial and political risk. In such multinational operations, the capital investment must promise high rate of return to justify the investment. So your capital budgeting and your capital investment must promise high rate of return to justify the investment. The parameters influencing decisions. Cash flow for a project. So when we do academic literature, academic studies, so these are the parameters: cash flow for project, period, interest rate for lending, interest rate for borrowings, available budget, planning horizon, etc. So these parameters are influencing your decision, capital budgeting decisions. But I don't think so. These parameters are included in the capital budgeting techniques. So some of the capital budgeting right now we are using some program-based capital budgeting techniques, sensitivity analysis, and nowadays the NPV, net present value, are calculated with the help of programs. So these variables are addressed by the programs. And decision variables, these variables are to be considered: the money lent from period to period, the money borrowed from period, positive deviation from the budgeted period, because when we plan the budget, we have to consider address positive deviations from the budget and negative deviation from the budget, and positive deviation from liquidity goal, negative deviation because the company maybe is a dynamic and their interest and aspirations are changing over a period of time. So sometimes a company maybe deviate from the liquidity goal because if liquidity increases, the profitability decreases. So there's opposite relationship between liquidity and profitability. So the company sometimes expecting more profitability, they can dilute the goal of liquidity. So these decision variables are important. So these decision variables and parameters are to be combined with the model while means predicting the future scope of the investment or capital allocations. So I already explained that NPV is the best method. I would say no. So NPV is not always the most appropriate investment appraisal method. The type of the company, industry, and most importantly, the CFO project manager's outlook decides the most appropriate method. So these factors, the type of the company, industry, and most importantly, the CFO project manager's outlook decides the most appropriate method. So NPV versus payback. So the payback, both normal and discounted, have one serious flaw. They don't consider the cost of capital. So payback method do not consider the cost of capital aspect, and the required rate of return can be a major determining factor. So can make or break a project. So the payback does not consider the so that this payback is not appropriate for every situations as compared to NPV method. Another flaw is that payback method is typically calculated only leading up the period in which the amount is paid back. So the post payback profitability, the post payback returns are not considered. So cash flows beyond the break-even point is completely ignored. So the payback is not suitable. But cash flows beyond that point can be substantially, in many cases. I said the investment in startups. In startups, after break-even, they will be, they will be big success after the break-even point. So this payback period is not considered not very good for evaluating projects of startups. So NPV versus weighted average cost of capital, there is an inverse relationship between weighted average cost of capital and NPV. NPV, as we said, that NPV is the present value of cash inflows minus the present value of cash outflows. So there is an inverse relationship. If NPV increases, weighted average cost of capital decreases. So higher the weighted average cost of capital, the NPV means higher the weighted average cost of capital, lower the NPV, and the higher the NPV, lower the weighted average cost of capital. Okay, so it's inversely related, NPV and weighted average cost of capital. So another topic I would like to explain, that is dividend policy. So dividend policy is important for academics being interested in the topic of evaluating the performance of capital market. So dividend policy is important in the sense that the decision to pay dividend will influence the market price of shares or not. So Modigliani and Miller, 1961, says that dividend policy is important. A lot of studies on dividend policy, impact of dividend policy on the stock market prices, market volatility, etc. So some of the companies are not paying dividend. Now they are not interested to pay dividend, and they are interested for retained earnings. They will reinvest the whatever it is, the excess profit for future growth of the company. So Modigliani Miller says that this topic of evaluating the performance of the capital market, dividend policy, is important. So dividend payments are studied based on the frequency of payments, such as annual, semi-annual, or quarterly, or how much the company will pay. So dividend payments are studied based on the frequency of payments. Dividend may be paid. Some companies pay dividend quarterly. Some companies may pay dividend annual, semi-annual way. Okay. So one managerial concern is about how the company can maintain and enhance the value of the stock in the market through dividend policy. So there is a connection between the dividend policy and market price of shares. So that is the thing. So That is, again, there is a relevant and irrelevant approach here. Similarly, with the capital structure, there are relevant theories as well as irrelevant theory. So if a company pay dividend, that will influence the stock price or not. Okay. So types of dividend policy: zero payment, 100% payout, balancing approach. Some companies pay zero payment. That means they are not paying dividend at all, but their future is tremendous, wonderful. Some companies pay 100% payout. Whatever be the excess profit, 100% they will distribute to their shareholders. But the growth prospectus may not be as good as compared to the zero payment companies. Some companies using the balancing approach. So Berkshire Hathaway, you might experience this company, which is a company owned by Warren Buffett. The payout is zero. This Berkshire Hathaway is not interested to pay dividend. So Warren Buffett believes that he can better invest the money than its shareholders. So he is interested to invest because whatever excess money, he is interested to invest in the growth of the firm, future growth of the company. That will be better for the future of shareholders. They are getting more capital appreciation in the future. Okay. So relevant theories of dividend. So Al-Malkawi 2007 adds that due to uncertainty of future cash flows and information asymmetry, investors would prefer dividends to retained earnings. Okay. So in 2007, a study says that future is uncertain because as Warren Buffett says that they don't want to pay dividend to shareholders. They will reinvest the company, and the future prospects are important. But nowadays, future is uncertain. You know, some of the shareholders are not interested for future growth because future is uncertain. We cannot predict. So whatever amount right now will be beneficial for us. So some investors would prefer like that. So this theory includes two ideas. The dividend payout ratio is positively related to share price. So whatever decision to pay dividend, there are a lot of dates: dividend declaration date, dividend payment date, dividend crediting date. So a lot of dates. When a company decision to declare dividend, the stock price of the company may increase. Okay, and it is inversely related to the cost of capital. So if the company pay dividend, the total cost of capital will be reduced. Means the decision to pay dividend will influence the value of market value of the shares, as well as increase the wealth of the equity shareholders, and also reduces the cost of capital. But there is an assumption that investors would prefer dividends run than retained earnings. That is an assumption. Thus, firms must conduct a high dividend payout policy to boost firms' value. But this assumption is not always practical in all situations and in all countries' market. So this is a study by one person, Al-Malkawi, 2007. Okay. But this study was contradicted by many others later. So Miller-Modigliani is the opposite approach, and their approach is known as irrelevant theories of dividend. And Black and Scholes, you might experience that option pricing, who contributed about the option pricing and all, and develop an influential argument that dividend policy does not influence the stock price and cost of capital. So their argument is different. They say that the dividend policy does not influence the stock price and cost of capital. And the previous slide, Al-Malkawi says that the dividend will influence the cost of capital and value of the firm. But here is opposite direction. That is so that it is known as the irrelevant theories of dividend. So thus, dividend policy is not relevant to the stock volatility. So the stock prices will not influence, the stock volatility will not happen due to the dividend. Similar that way, the Modigliani, Miller, and Black and Scholes studies directed. So Miller-Modigliani suggests that dividend policy and shareholders' value are unrelated. So there is no relation between dividend policy and shareholders' value. Okay. So next, another one, agency theory. This agency theory claims that under information asymmetry between shareholders, owners and managers, dividend can function reduce the manager's appropriation problems. So the higher level of managerial ownership will decrease the dividend payment. That means this money, the excess profit, they use it for the manager's purpose. It's inserted as principal on firm's value, etc. So the agency theory. So this manager's decision, they won't interested to pay dividend, so that the companies are not paying dividend. So one of the theory, agency theory. And life cycle theory says that company has many life cycle stages, and every stage company has to follow different dividend policies. A growth phase company has to reinvest the entire profit. That means the payout is zero when the company is in growth phase. When the company is in maturity phase, the payout is 100%. Similarly, the life cycle stages. The life cycle of the company is a determining factor while deciding the dividend policy. The firm in the growth phase of their life cycle increases the cash reserve, whereas those in maturity phase increase dividend payouts. So that means life cycle theory. Then bird in hand theory is another one. Bird in hand theory contributed by Linter and Gordon and Shapiro in 1956 admit that receiving expected dividend are more valuable than waiting for capital gain. Similarly, like Malkavi's approach. Okay, so bird in the hand. There is a proverb: a bird in the hand is better than two in the bush. Okay, so investors prefer the current earnings rather than the future earnings, future capital gains. So Lee 99, firms' willingness to pay out dividend has increased significantly over the year. Means he said that companies paying dividends are increased over the years. Then another one, residual dividend theory. The residual dividend theory states that firms pay dividends when they have cash residuals after having fulfilled all the available investment demands. So this is a simple theory. This theory says that firm can pay dividend. There are excess cash after fulfilling all the growth investment demands. Okay. So there are another one. There are a lot of theories. Signaling hypothesis. So the signaling hypothesis shows that increase in dividend payments is positive signal to good prospects of the firm's earnings and vice versa. So a firm can give a signal that is like a manipulation. Not like manipulation. So company can signal that if the company pays dividend, that means the company is in a better stage. So that the company, with some companies, they are increase the market price of for increasing the market price of share, they are giving the dividend. So I don't want to support this hypothesis. Signaling hypothesis means company can give a signal to the public that company is in a better position, so that the company can pay dividend, right? So okay, so citations, Malkavi, Miller, Miller and Modiglani again says like that, but he is against the relevancy approach. The cliently effect theory says that different investors group will prefer different dividend policies. So the company can do an analytics, what kind of shareholders they have. The shareholders are pensioners and they are interested to get the dividends. So the company can pay dividend based on the interest of the shareholders group. Okay, that is known as cliently effect. Then expectation of shareholders is important while deciding the dividend policy. Investors who pay higher taxes will expect business to pay little or no dividends. And they should be compensated in terms of the gains from the growth of stock price, because a person who is in the higher tax bracket essentially interested to get the capital appreciation rather than dividend. In contrast, a small investors would prefer the companies paying dividends. So I can state that some of the shareholders, they are interested to get the dividend, but some of the shareholders are interested for the capital appreciation in the future. So different type of shareholders, as rightly said by this Al Malkavi and all. And 2021, there is a citation discovers that growth opportunity, capital expenditure, CEO overconfidence are positively related to no dividends no profit, no repurchase. So there is a policy by the company, that is no dividend, no buyback, and high profitability. So the company's ambition or goal is like that. So because the company has a growth opportunity, company has high capital expenditure, and the company CEO has overconfidence. So that reflect that taking of this policy, no dividend, no repurchase, and high profitability. So in addition, we can find that no dividend, this NDR means no dividend, no repurchase, and high profitability. So these companies will not declare dividends because of CEO's overconfidence, and they have high growth opportunity. So they have a hypothesis. Firms that voluntarily pay zero dividends, including share repurchases, are more likely to have high growth opportunities. So firm that voluntarily pay zero dividends, so including share repurchases, are more likely to have high growth opportunities. Okay. So firms that voluntarily pay zero dividends, including share repurchases, are more likely to have high capital expenditures. Okay. So if the company has high growth opportunity or high capital expenditure spending, the company's payout ratio is 0. Okay. It's because of the overconfidence of the CEO, maybe the overconfidence of the CEO, that the company has many growth opportunity, company has to spend a lot of amount for capital expenditure. So it is not good for the time being to declare dividend. Okay. The next is working capital management. Snehid, so what about the timing? Can I extend to 15 to 20 minutes?
Yes, sir. You can extend to 15 minutes. You can. Yeah.
Okay. So working capital management, is also been part of the syllabus. Positive working capital generally indicates that company is able to pay off its short-term liabilities. So positive working capital indicates that a company is able to pay off its short-term liabilities almost immediately. So negative working capital generally indicates that company is unable to do so because company is unable to pay off its short-term liabilities. So that is the definition. Positive and negative working capital. Working capital may be positive or negative. So analysts are sensitive to decreases the working capital, but the company should be careful to maintain a balanced working capital, optimum working capital. So these analysts suggest a company is becoming over leveraged, is struggling to maintain or grow sales, is paying bills too quickly, or collecting receivables too slowly. Okay, so decreasing working capital is a critical situation in a company. But it is also not good companies maintaining over investment in working capital. So company has to make an optimum level of working capital. So there are several ways to evaluate companies' working capital further. There are ratios are available to cross-check the efficiency of the working capital management, like inventory turnover ratio, receivable ratio, current ratio, quick ratio. These ratios, these current, quick, inventory turnover, receivable turnover, working capital turnover ratios are important to check the efficiency of the working capital management of companies. So working capital management, so short-term decisions focus on liquidity and the composition of current assets and current liabilities. So working capital management involves decision making primarily related to size and effectiveness of working capital. So effectiveness of working capital is important, and the investment in working capital. So business failures are often due to the inability to manage current assets and current liabilities. So there are business failures arises due to the inefficiency of proper working capital management. So working capital management, many enterprises have gone bankrupt despite healthy operations and profit owing to the mismanagement of working capital. And there are literature based on this. Then appropriate investment in working capital is necessary for firms' daily operations. So because of money invested in working capital is often high relative to a firm's total asset. financial managers should be effectively use of working capital component. So I said there is an optimum usage of working capital, optimum investment in working. It is not like this too high investment in working capital is not good, and it's too low investment in working capital is also not good. So there are two approaches of working capital: a situational change approach and risk avoidance approach. So Smith and Sell 1980, a situational change approach primarily focus on maintaining a flexible working capital management policy. So a flexible working capital management policy to deal with fluctuations in demand. So in this approach, firm maintain high level of inventory to eliminate risk of stockouts, because here the company using a flexible working capital management policy, so that the company should maintain sufficient level of inventory to eliminate the risk of stockouts. So another approach, that is risk avoidance approach. Here there is a static working capital policy. Here a company maintain a permanent, there is a working capital, you can refer that permanent working capital, temporary working capital, etc. So here there is a static working capital. Static working capital means maintenance of investment in working capital is fixed, and it is concentrated on reducing the investment in working capital. Okay, so two approaches: situational change approach as well as risk avoidance approach. So working capital consists of cash management, inventory management, receivable management. Here the operating cycle is also important. So operating cycle analyze the accounts receivable, inventory, accounts payable cycles in terms of days. So accounts receivables are analyzed by the average number of days it takes to collect an amount. So it's part of operating cycle. It should be fast enough. Account receivable, the amount takes to collect the receivables. Inventory is analyzed the average number of days it takes to turn over the sale of a product. From the point it comes in your door to the point it is converted to cash. Then accounts payable are analyzed by the average number of days it takes to pay a supplier invoice. So we can extend the account payable, but we need to fasten up the account receivable as well as inventory to increase the speed of the operating cycle. The cash management is very important in working capital management. So the main determinants of cash management are banking and economic environment of the nation, and liquidity of security market is also very important. And because we are we can do some working capital management with the help of these marketable securities. We can invest in money market as well as these mutual funds, etc. In a short time. So we should consider the liquidity on security market while planning of working capital management. Then exchange rate is also important, because a multinational company doing working capital management practices, they have to look on these exchange rates. And efficiency of the financial system is also very important. Financial system should be sound. If the country working financial system should be a very fair one, then they can plan the working capital management accordingly. And inflation and market regulation, etc., should be strong. Market regulation should be strong. Then also suggest that firms prefer using account receivables rather than cash for number of motives. There are a lot of motives: transaction motive, precaution motive, speculative motives, and all. These motives are important, and I suggest to learn all these things: motives of holding cash, motives of holding inventory, motives of holding receivables. So these motives are important. So we are doing transactions for these motives. So it can be available from the books. So you can learn these motives of holding cash and all. Then centralized and decentralized cash management. Centralized cash management implies that receipts and payments in currencies are managed by one single central body, which is centrally the head office of MNC. So one single central body, which is generally the head office of MNC, that is deals the entire receipts and payments in currencies. But This approach is more effective as it involves calculation of corporate position in each currency by adding position, because we can understand, we can understand the position of entire position as well as each currency's position, because we are dealing with this centralized cash management. Means only one, the recipient payments in currencies are managed in one single central body, so that we can understand Indian rupee position, dollar position, euro position, yen position, etc. And overall position also we can understand, because it is not decentralized. So we can check from the one point. So decentralized cash management implies that these receipts and payments are managed locally by subsidiaries. So subsidiaries has given autonomy power to manage this cash management. But this approach, we cannot understand the country-wise, the currency-wise total receipts and payments. This approach is useful when delays are expected. If we need to fasten up, we need to speed up the transactions and payment and the receipt, we have to adopt decentralized cash management. But the accounting is more centralized in centralized cash management system. Okay. So playing with float, the working capital manager is always interested to playing with the float. So float is essentially double counted money, a paid sum which due to delays in processing appears simultaneously in the accounts of the payer and the payee. Okay. So when we get a check and immediately we crediting the amount, but it will take time to credit the amount actually. So that is a float. The time taken to credit, time taken to pay, because both parties have entered as debit and credit side of their books. That is a float. So individuals and companies alike can use float to their advantage, because we used it to delay the payments, but we used it to speed up the receipts. That's always tendency of the people. In companies also, similarly they are doing these things. They are playing with a float. Okay, so the float is different types of float, cash float, etc. So it can be available in the books. Next is a part of syllabus, that is asset securitization. So it's very important. Asset securitization, a bank, we can take an example of bank, they have a lot of assets in the sense, the loans are assets of the bank. So some of the loans are, properly serviced by the borrowers. Okay, properly serviced by the borrowers. So in securitization, an originator pools or groups debt into portfolios which they sell to issuers. The bank is interested to securitize their properly serviceable loans is possible. So issuer designs a marketable financial instruments by merging or pooling various financial assets into one group. So there is a separate agency is known as special purpose vehicle, and this special purpose vehicle do all these things, and they will collect loans, means properly serviceable loans from the bank, and these loans are converted into securities, and these securities are available to the open market, and people purchase these securities. Means maybe bonds, the major so some noise is coming out. Is this okay?
Yes, sir, yes, it's okay.
Okay. So the issuer then sells the group of I will show the thing, the first and second and third step. Individual borrowers contract loans with the bank, and the bank, the originator is known as a bank, and the bank sells the assets to SPV, means special purpose vehicle, also known as loan trust. This reduces the bank's liabilities portion of its balance sheet. So bank's liability portion can be reduced. Bank get immediately the payment back from these originator or special purpose vehicle. For example, if the bank sells 10 crore loan to the special purpose vehicle, the bank will get immediate receipt 10 crore amount. The bank's liability position was eliminated because 10 crore has been eliminated as a as a loan, means this reduces the bank's liability portion of its balance sheet. Okay. Then investors such as mutual funds invest in SPV in exchange for promised monthly mortgage payments. Okay. So some investors are interested to purchase these bonds. Okay. Then the borrowers, the borrowers are regularly paying or servicing the interest as well as principal amount to the bank, and these receipts are taken to repay back the or service the instruments purchased by uh, the public. Okay, I will show the structure of securitization. Here the originator is known as bank, and there is a special purpose vehicle, and there are investors. So these investors are the real borrowers from bank. They take housing loan, education loan, etc. And these loans, means proper serviceable loans, are converted or sell to the special purpose vehicle. Okay, sells to the special purpose vehicle, and the bank will get immediate receipt from the special purpose vehicle. Okay, and this special purpose vehicle convert these loans into some securities, maybe bonds, and this is open to the public, or some investors or mutual funds purchase these securities from the special purpose vehicle. And these bonds consist of proper credit rating by some agency. Okay, credit rating is also available. And after that, the borrowers they will pay the interest as well as principal amount, and this interest or principal amount to special purpose vehicle, and this amount will be utilized for paying off these investors and mutual funds holders. Okay, so this is the entire structure of the securitization process. So international monetary system is again big topic to discuss. International monetary system, there are 4 standards: gold standards 1876 to 1930, interwar years, this 1914 to 1944. Here there is no standards at all, interwar years. And Bretton Woods system, here 1945 to 73 period, that is IMF and World Bank. This Bretton Woods system. Again, the Bretton Woods system were collapsed and flexible exchange rate regime since 1973. Okay, this is a international monetary system. It's again is a big topic. So gold standard 1876-1930. The fundamental principle of the classical gold standard was that each country should set a par value for its currency in terms of gold and try to maintain its value. The gold standard was prevalent in this stage because the currency value is determined in terms of the gold. But after some period, the nation understand that this standard is not practical, so gold standard change. Again, there's 1914 to 1944, that is interwar years. The gold standards as in international monetary system worked until World War I interrupted trade follows and disturb the stability of the exchange rate for currencies in major countries. So this interwar years, there was a change happened. The Great Britain was the major creditor nation, but the situation changed to US began to assume the role of leading creditor nation. So US has got power in this region. And Bretton Woods system 1945 to 1973. And IMF and IBRD were emerged. The IMF is interested to to maintain international liquidity, but IBRD is interested. The IBRD has been termed as the World Bank. IMF is being termed as a central bank, and the World Bank is interested. They are interested for reduction of poverty, etc. But IMF is interested to maintain international liquidity, maintain balance of payments of countries, and reduce exchange rate problems, etc. So there are after exchange rate regime, this floating exchange rate is now prevailing. Fixed exchange rate region was over. Now floating exchange rate system, the pegging of currency, crawling peg, and target zone arrangement. These are available in the books. You can read this international system. And exchange rate risk, there are hedging tools. Exchange rate is always fluctuating as demand and supply factors. So exchange rate markets, 24 hours market available, and you can trade currency. I mean, selling and buying of currency is possible. So exchange rate risk is most common. So it can be avoided through exchange rate hedging arrangements such as currency forwards, futures, and options. Okay, so exchange rate risk is not completely avoidable, but it can be reduced through hedging tools. So another one is cross listing. Cross listing is important. Cross listing is a listing of a company's common shares on a different exchange rather than its primary original exchange. So Infosys is listed in Indian Stock Exchange, as well as Infosys is listed in Nasdaq and New York Stock Exchange. This is not as important to discuss GDR and ADR. So GDR and ADR is a product of cross listing. So the company in question must meet some requirement as any other listed member of exchange about accounting policies. So this requirement means the company goes for cross listing, means the company goes for New York Stock Exchange listing or London Stock Exchange listing, need to comply the rules and regulations of that London Stock Exchange or New York Stock Exchange, as the case may be. So these requirements include the initial filing and ongoing filing with the regulators and a minimum number of shareholders and minimum capitalization, etc. So these rules are strict and stringent, and the company has to follow these rules given by the other country stock exchange. So cross-listing program. Since the 1920s, the New York Stock Exchange has provided a cross-listing mechanism through its American Depository Receipt. So you might have experienced that American Depository Receipt is a product of cross-listing program of New York Stock Exchange. And another one is London Stock Exchange. 94. Since 94, they have started cross-listing, has also provided a cross-listing mechanism through its GDR. So GDR is outcome of the cross-listing program of London Stock Exchange. So ADR and GDR, it's actually different products. Companies from across the globe have choice of cross-listing shares as either American or global depository receipts. So ADR is primarily listed in US Stock Exchange like New York, Nasdaq, and AMX. And GDR is also issued. GDR is issued on non-US market. It's mainly London Stock Exchange. Okay, GDR is issued into London Stock Exchange. So GDR listed in London Stock Exchange are subject to simplified disclosure. Again, there are a lot of academic literature. A company can easily go and take listing. Even the government of Kerala, they have listed London Stock Exchange and issued a product called Masala Bonds. So the listing procedures are very simple as compared to ADR. So ADR means the company has to be listed in New York Stock Exchange, and the listing requirements are very high. Similarly, if you take National Stock Exchange and Bombay Stock Exchange, National Stock Exchange listing norms are very strict as compared to Bombay Stock Exchange. So that all the small companies were listed in Bombay Stock Exchange rather than National Stock Exchange. But big companies, they are listed in both stock exchanges. Here also ADR, for issuing ADR, the companies need to be listed in US Stock Exchange, but the listing norms are strict. But for issuing GDR, company need to be listed in London Stock Exchange, but the listing norms are more simple as compared to ADR. So proponents of the light touch approach argue that firms cross-listing as GDR are not subject to their high reporting cost faced by the ADRs. So ADR versus GDR. GDR target global investors and are pursued primarily by companies from emerging and developing market. So GDR issuers are from emerging and developing market like India and China, while ADR have been the major investment tools for US-based investors. So GDR have a light touch, simplified disclosure requirements, which stand in contrast to the full scope disclosure that exists for exchange. So already discussed. This is a structure India overseas Indian company, and there is a depository agreement with an overseas depository. So the overseas depository may be a bank, and the equity shares are converted into so ADR and GDR accordingly, and they sell or issued these instruments to overseas investors. Okay, this is a structure. And again, IDR, that is Indian Depository Receipts. So Indian Depository Receipts is a financial instruments which enable foreign companies to raise funds from the Indian security market. Okay. So IDR is dominated in Indian rupees in the form of depository receipts created by domestic depository. So these are the companies, issues ADR, and you can see all these things from Yahoo Finance. Okay, thank you. Thank you for listening me this 1.5 hours. If you have any questions, you can please ask.
Yeah, so participants, if you have any questions, you can clear now, because sir is an expert in this area. I mean, he's also an active researcher and trader as well. So if you have any sort of doubts, your questions, you can ask now, or else we can wind up the session. Okay, so then we can wind up the session. So we have come to the end of the session, and I would like to express an overwhelming gratitude to Biju sir for spending his valuable time with us for enlightening the session. I understand that he was having a very busy schedule with his academic works and all, but he found time for spending with us. Thank you so much, sir, on my personal behalf, as well as on behalf of the Commerce Club. Thank you so much, sir.
Thank you, Snehit, and thank you, the people behind this program. Thank you all.
Yes.
Okay.
Thank you to all the participants for hearing the session and actively supporting the club activities. And the next session will be on legal aspects of business handled by